Greetings and good day. Let me to introduce myself first. I am Madhushan Priyadarshana, Assistant Lecturer in Accountancy attached to ATI KGO. With this session, I am going to take you through LKAS 16, which is a very familiar standard for you, that is property, plant and equipment. So these are the key areas I am going to discuss throughout this session. First, I will discuss on some of the key definitions given in LKAS 16 and on how to recognize and measure property, plant and equipment, and then on depreciation, on revaluation and on disposal. Right. If you take an annual report, so you could notice that PPE balance, property, plant and equipment balance in the balance sheet represents the highest balance there. Right. This is especially in the case of manufacturing companies. Right. If you go to the note of PPE, so you would identify that there are some assets like machineries, computer hardwares, right, lands, buildings. So those have been identified under PPE. So this identification whether a particular asset belongs to PPE or not, right? This identification comes from its definition. Right? If a particular asset meets the definition of a PPE as per LKAS 16, then we can identify such asset, right, under PPE. Right? So LKAS define property, plant and equipment as tangible assets that are held by an entity for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one period. If you carefully go through this particular definition, you would identify that this definition highlights three things. Right? First, it should be a tangible asset. Right? It should be a tangible asset. Right? That is why we do not consider goodwill, right? Some of the intangible assets like goodwill and brand under PPE. It should be tangible. Right? For intangible assets, we have a separate standard, right, on how to account for those. Right? So the first thing, if an asset to be identified as a property, plant and equipment, right, it should be a tangible assets. And we should expect it to be, that asset should be expected to be used during more than one period or more than 1 year, right? So it should be tangible and we should expect it to be used, that particular asset, for more than 1 year. And then the third point is on the purpose, right? Why we are holding that asset, right? They have given three purposes. If we are holding either for one of these three purposes, right, then we can identify it under PPE, right? So the purpose one is it should be used, right, for production or supply of goods or services, right? Production or supply of goods or services. That is why we identify machineries under PPE. Why? We use it for the production of goods, right? We use machineries for the production of goods. Those are tangible and most of them are expected to be used more than for 1 year. Then we identify such under PPE. And that is why we identify delivery vehicles under PPE. Why? We use it for supply of goods or services, right? Or for rental to others, right? If we are having a machinery and we are keeping that machinery to earn some rental income by renting to others, such items, such assets also we can identify under PPE, right, as per this definition. Or for administrative purposes, right? That is why we identify assets like office chairs, office tables, computer hardwares. Why? We are using it for administrative purposes, right? Those are under PPE, right? So it is very important to understand the definition, right? So in determining whether a particular asset should be identified under PPE or not, right, that should be determined based on the based on this definition, right? Three things: it should be tangible, and it should be expected to use for more than 1 year time period, and we should use it either for production or supply, or for rental, or for administrative purposes, right? Cost. Cost is the amount of cash or cash equivalents paid, or the fair value of the other consideration given to acquire an asset at the time of its acquisition or construction, right? Assume we are going to purchase a machine, right? So today we pay in cash 1 million, and we agree to pay another 1 million in another 2 years time. So when determining the cost, right, we should not only consider the amount of cash or cash equivalent we have transferred, and the fair value of the other consideration given also we need to consider in determining the cost. It means the fair value of the 1 million, right, which we are expecting to pay after 2 years, we need to consider as the cost, right? Fair value. Fair value is the price that would be received to sell an asset. If we sold that asset, what is the price that we would able to get, right? Or pay to transfer a liability in an orderly transaction. So what do you mean by this orderly transaction, right? It means the transaction should be at arm's length, right? If a transaction, right, if you have your own company, and if your father has another company, if some transaction takes place between your one and your father's one, right, so there is a probability that those transactions may be not at an arm's length, right? So here, when determining fair value, it says it should be an orderly transaction. That transaction should take place at arm's length between market participants, right? So market participants means what? Buyers and sellers. At the measurement date, right? When this transaction take place, the value as at that date we need to consider, right? That is fair value. Carrying amount. Carrying amount is the amount at which an asset is recognized after deducting any accumulated depreciation and impairment losses, right? If we put this into a formula, right, it is cost minus accumulated depreciation minus accumulated impairment losses, right? Now on recognition and measurement, right? So recognizing means, right, we identifying it in our P&L or balance sheet, right, on our income statement or balance sheet, right? The figures we identify, right? So when it comes to recognition, an item of PPE is recognized, right, when there are two criteria given. The first one is it is probable that future economic benefits associated with the asset will flow to the entity, right? Future economic benefits associated with the asset will flow to the entity. And the second criteria is the cost of the asset to the entity can be measured reliably, right? It should be probable that future economic benefits associated with the assets will flow to the entity, and as well as the cost of the asset we should able to measure reliably, right? So this is compatible with the recognition criteria given in the conceptual framework, right? Then when it comes to measurement, so we have the initial measurement and subsequent measurement, right? And item of PPE is initially measured at cost, right? Initially, right, we have no option, we need to measure an item of PPE at cost, right? This cost is comprising with these three things, right? This cost includes purchase price, right? Purchase price and directly attributable cost, right? Directly attributable cost of bringing the asset to work in condition for its intended use, right? For an example, the cost of site preparation or cost of initial delivery, cost of initial handling, right? Or professional fees, right? So those cost, right? Cost of bringing the asset to work in condition for its intended use, right? We identify as directly attributable cost. And cost of dismantling, right? Assume, right? We have, right? We have purchased a particular plant, right? So in another 5 years time we need to dispose this plant. When disposing this plant, right, for an example, environmental authority, right, may impose us, right, some of kind of a penalty, right? You have to pay this much of amount in another 5 years time at the time of your disposal. So at, at the initial measurement we need to identify such cost, right? When we are going to dispose this, right, how much we will have to pay. It may be to the government or it may be to the public, right? Whatever. So the present value of such cost we need to determine, right? That is why what it tells here, right? Cost of dismantling. So when determining, right, an item of PP initially, right, initially it is measured at cost. So this cost is comprising with purchase price, directly attributable cost, and cost of dismantling, right? So let me to do the example number 1, right? Here ABC company is installing a new plant at its production facility. It has incurred these costs, right? Some of the costs are given and we need to find out the cost to be capitalized as per LKAS 60, right? Now you know initially an item of PPE should be measured at cost. This cost include what? 3 things: purchase price, directly attributable cost, and cost of dismantling, right? Cost of the plant 250,000. So this is the purchase price. Therefore, we need to consider it as our cost, right? Include in our cost. Initial delivery and handling cost. Initial delivery and handling cost. Bringing the asset, right? Bringing the asset to the intended use, right? So this is a directly attributable cost. Therefore, we need to consider. Cost of site preparation, again a directly attributable cost, therefore we need to include under the cost. Interest charges paid to suppliers, right, paid to supplier for deferred credit, right? To purchase this plant we may have obtained a loan, right? For that loan this much of interest we need to bear, right? So this can be capitalized if this particular plant can be identified as a qualifying asset, right? This 20,000 can be regarded as borrowing cost if this plant can be identified as a qualifying asset, right? So that will be discussed in LKAS 23, right, under borrowing cost, right? For the moment we will is not an qualifying asset, right? Therefore this interest charge we are not going to identify under cost. Then estimated dismantling cost to be incurred after 7 years, right? In present value terms we are given 30,000. Yes, of course this is cost of dismantling, right? The present value is given, right? So we do not need to discount further. It is 30,000. Then operating losses before commercial production, 40,000 rupees, right? Operation losses in the standard itself, right, guides us to ignore, right? Operating losses we cannot identify it under the cost of an asset. Those should be expensed separately, right? So it is the sum of these values, right? 250,000, right, plus 20,000, right, 250,000 plus 20,000 plus 60,000 plus, right, 30,000, the cost of dismantling, right? So the initial cost of this plant we need to identify should be rupees, right, 360,000, right? It should be 360,000, right? So that is example number 1. Then subsequent measurement. When it comes to subsequent measurement, the standards allows us two options. That is, we can follow either cost model or revaluation model, right? We can follow either cost model or revaluation model, right? Cost model means, right, so the carrying amount, right? Cost minus accumulated depreciation minus accumulated impairment losses, right? Revaluation model means, right, we need to consider the fair value, right? Fair value of the asset at the end of each financial year, right? So whatever the model we used for subsequent measurement, we should be consistent with it, right? We should be consistent with it, right? Okay. Then the next subtopic on depreciation, right? Depreciation, right? So there are also I have given some definitions, right, to identify, to get an understanding on what is this depreciation is about, right? So depreciation is the systematic allocation of the depreciable amount, right, of an asset over its useful life, right? So depreciate means what we do, right? We systematically allocate the depreciable amount of an asset over its useful life. So what is this depreciable amount? So what do we mean by this depreciable amount, right? It is given in the second point. Depreciable amount is the cost of an asset or other amount substituted for cost less its residual value, right? So cost minus residual value will give us the depreciable amount, right? If we put it into a formula, depreciable amount equals cost minus residual value, right? Then what is this residual value? Residual value is the estimated amount that an entity would currently obtain from disposal of the asset after deducting cost of disposal, right? If the asset were already the agent in the condition expected at the end of its useful life, right? This is an estimated figure, right? If this particular asset is fully utilized, right, what is the amount we can sell the residuals of this asset, right? That is we identify as residual value. In determining that, right, if we need to bear some cost, right, cost to dispose these residuals, we need to deduct such cost as well. Useful life, right, depreciable amount, right, of an asset over useful life, right? Useful life is either of the following, right? Useful life. First one, the period over which an asset is expected to be available for use by an entity. Right? Time basis, for how many years we are going to use this asset, right? And the second point, part B, is the number of production or similar units expected to be obtained from the asset by the entity. Unit basis, how much of units we are going to produce by this asset, right? So the management can decide either of these two, whether to go on, whether to determine the useful life based on the year basis or time basis or on unit basis, right? That is up to the management, right? So we have another example, example number 2, right? Right. right? So here this is example number 2, right? So here if you can see this one, right? An asset cost 300,000 and has a residual value of 40,000. The asset has a useful life of 20 years, right? The cost of the asset is 300,000, right? Residual value is 40,000 and the useful life is 20 years. What we need to do is we need to calculate the depreciation charge per annum, right? Per annum, what should be our depreciation charge? So you know by now depreciation means what, right? It is a systematic allocation of the depreciable amount over its useful life, right? So depreciable amount we need to divide by the useful life. Depreciable amount means what? Here we have discussed depreciable amount is the cost of an asset or other amount substituted for cost less its residual value, right? Cost minus residual value. Cost is given 300,000, right? Minus residual value. Residual value is given as 40,000 over its useful life. Useful life is 20 years, right? Therefore, what should be the depreciation charge per annum? 260,000, right? 260,000 over 20, right? 13,000. So 13,000 should be the depreciation charge per annum, right? That is example number 2, right? Then commencement and cessation, right? Commencement and cessation of depreciation. When we should start depreciation and when we should stop doing depreciation, right? Depreciation commences when an asset is in the location and condition necessary for it to be used in the manner intended by management, right? Assume we have purchased a machine on 1st of April, right? So but it is still not in the location and condition necessary for, right, necessary for it to be used in the manner intended by management. So we need to do certain modifications, right? We need to do certain testings, right, to make that machine, right, to make that machine into the location and condition, right, that is expected to be used by the management, right? So assume we have purchased the machine on 1st of April and we have done certain modifications. By 30th September, right, that machine is in the location and condition, right, as intended by management, right? So 1st of April we have purchased, 30th September, right, it is ready to use, right? It is ready for us to use. So then we have to start depreciation not on 1st of April but from 30th September onwards, right? That is what it says. Depreciation ceases at the earlier of either of the following, right? Whatever happens earlier from that point onwards, right, we are not going to depreciate anymore. Classification as held for sale in accordance with SLFRS 5, right? So you will learn this particular standard in your next semester, right, under advanced financial reporting, right? So if we have an asset and if we are not going to use it, right, we hold it solely for the purpose of selling, right? We have a machine, we are not going to use it, right? If a customer comes and asks for a particular price, we are going to sell it, right? In such situations, right, such assets we are not going to depreciate. And on disposal, right, from the point of disposal, no more we are going to depreciate, right? So we have this residual value and useful life, right? Residual value and useful life, both of these are estimates, right? Management estimates, right? So these, right, must be reviewed at least at each financial year in both residual value and useful life, right, must be reviewed at least at each financial year end. Why? These are estimates, right? This estimate we need to review at least each financial year end, right? If there are any changes to the initial estimate, right, if there are any changes, those we need to account as per LKAS 8, right? Whether there is a change in the residual value or in the useful life, such changes we need to account as per LKAS 8, right? LKAS 8, which is the accounting standard for accounting estimates, right? Changes in accounting estimates, right? Policies and errors, right? Here in residual value, where residual value exceeds carrying amount, the depreciation charge is zero, right? Residual value exceeds the carrying amount, the depreciation charge is zero. You know, depreciation means what? A depreciable amount over useful life. So depreciable amount can be determined by carrying amount minus residual value, right? Here, carrying amount minus residual value. If the carrying amount is 1000 and residual value is 1500, that is what it says here. Residual value exceeds carrying amount. Carrying amount is 1000, residual value is 1500, so it exceeds. In such situations, right, so the depreciable amount is a negative balance, right? 1000 minus 1500, it is minus 500. In such situations, right, we are not going to depreciate, right? The depreciation charge is zero. The depreciation charge is zero. On useful life, right, we need to consider certain factors, right, in determining useful life, right? We need to consider the expected usage of the asset, right? Expected usage of the asset and expected physical wear and tear. If we use particular vehicles on the coastal area, right, they may be subjected to quickly, right, quick wear and tear, right, rapid wear and tear, right, or technical or commercial obsolescence we need to take into account, and legal or similar limits, right? So these factors we need to consider when determining the useful life, right? We have another example, right? Example number 3, right? Example number 3, this should be example number 3, right? What it says, example number 3, right? Adhikari Gardens Private Limited acquired a large piece of machinery on 1st of August 2017. Right, on this date they have acquired a machine, right, at a cost of 120,000. Cost is 120,000. The machine was estimated to have a residual value of 15,000 rupees. This is the residual value. This is the estimate they have made, right? And a useful life of 10 years. Right? Initial estimate we can use this particular machine for 10 years. Right. On 31st December 2018, on this particular date, the residual value of the machine was reassessed. Right. Annually we need to assess. Right. As per that, on this date as well, they have reassessed. Right. Reassessed to be nil. Initially we estimate it should be 15,000, but on this date, right, we come to a conclusion. The management decides there is no more residual value. The residual value should be nil, and the remaining useful life to be 5 years, right? Remaining useful life, initially we estimate 10 years, but it is not it should be changed. It should be 5 years from this point onward, right? These estimates were applied from 1st of January 2019, right? From 1st of January 2019, right? So we are required to calculate the depreciation charge in each of the years ended 31st December 2017, 31st December 2018, and 31st December 2019, right? Okay, depreciation charge here 2017, right? Here we have 31st December 2017. From 1st of August to 31st December, how many months, right? 5 months, right? So initially for 2017 we need to depreciate for 5 months, right? So depreciation means depreciable amount over useful life, right? Depreciable amount means cost minus residual value, right, over useful life, right? 10 years in months, 120 months, right? 10 into 12, 120 months. We need to depreciate, right? We need to depreciate for 5 months, right? 2017 we have this asset, we use this asset only for 5 months, so we depreciate only for 5 months. Therefore, right, the depreciation amount, right, the depreciation amount for the year 2017 should be, right, 4375, right? 4375. 2018, right? 2018, these estimates have not been changed, right? Initially estimate this much of residual value, right? Useful life we have estimated to be this much of years, right? Those things have not changed during 2018, right? Therefore, right, now, right, we need to consider the depreciable amount. On this date, on 31st December 2017, right, we are at this date, to 31st December 2017. On this date, what is the depreciable amount, right? Further, how much we can depreciate, right? So we had a cost of 120,000, right? We had the cost of this much, and we have already depreciated this much, right? This is what we call the carrying amount, and residual value has not been changed, that is 15,000, right? That is 15,000, right? And useful life, right? From, if we are at this date 31st December 2017, right, from this date onward we can depreciate this particular asset for another 9 years and 7 months, right? For another 9 years and 7 months. Why? We have depreciated 5 years already, right? From the initial estimate of 10 years, for 5 years we have already depreciated. Now we are at here, right? So it means, right, for further in months, for further 115 months we can depreciate, or we are expected to use this particular machine, right? We are expecting to use this machine for another 115 months, right? So this year, right, for the whole year we can depreciate, right, from 31st December 2017 to 31st, right, December 2018. For the whole year we can depreciate, right? So the value should be this much, right? 10,500, right? 10,500, right? 10,500, right? 2019. Now the impact of these change in estimates affects to our depreciation as well, right? Okay, so we are going to depreciate for this year from 1st of January 2019 to 31st December 2019. For this particular, we are going to depreciate, right? Now we need to determine the depreciable amount, right? So the cost of the asset was this much, right? We have already depreciated for the year 2017 this much, right? For the year 2018, 10,500, right? So this should be the carrying amount as at 1st of January 2019. From that, we need to deduct the residual value. But now we have, our estimates have been changed, right? This is effect from 1st of January 2019, right? We applied from 1st of January 2019. So the new residual value is nil, a zero, right? This need to be divided by the useful life, right? Right? Now we have a new useful life, right? From this point, so now we are here, right? So we expect now the new estimate of our useful life is 5 years. It means for another 5 years only we are going to use this asset, right? Therefore useful life is 5 years, right? For the whole year we are going to depreciate, right? It means the depreciation charge for the year 2019 should be 21,025, right? That should be the answer for example number 3. Right. Depreciation method, right? You know there are three methods, right? Three methods prescribed in the standard LKAS 16. Those are straight line method, reducing balance method, and units of production method. So whatever the method we used, right, it should reflect the pattern in which assets' future economic benefits are expected to be consumed by the entity. How we are going to consume the future economic benefits of these assets. Based on that, we need to determine, right, what method we are going to adapt to depreciate these assets, right? So if it is a straight line, what happens? So we equally depreciate, right? There will be an equal depreciation charge arises each year, right? Or if we are expecting to use a particular asset, right, on an equal term, right, on an equal term in each year, right, straight line method should be the most appropriate method, right? Or if there is a particular asset, on initial years we are going to use it more, right, and gradually we are going to decrease the use of that asset, right? Reducing balance method may be the most useful, most appropriate method, right? So depreciation charges are higher in earlier years of use and less in later years. Or we can use units of production method, right? So there are the results in charge based on expected use of output, right? On how much we have used, right? How much of outputs we have produced, based on that we can depreciate, right? So these are the three depreciation methods, right, recommended in the standard. So this depreciation method is also, right, is also an estimate how we are going to, right, how we are going to consume the future economic benefits of these assets. It is also an estimate, right? So therefore this also, the depreciation method also must be reviewed at least at each financial year end, right? Depreciation method must also reviewed at least each financial year end. And if there are any changes, right, on, right, for the first few years we have depreciation on a straight line, then suddenly we, right, we come to a conclusion, no, from this point onward we need to change our depreciation method to the residual value method, right? It is, right, more appropriate method to reflect the pattern we consume the future economic benefits, right? If the management comes to such conclusion, then of course, right, the depreciation method need to be changed, and we should regard it as a change in accounting estimate and account it as per LKAS 8. Right, we have another example, example number 4. right? Example number 4. Right, this should be example number 4. The company acquired an asset on 1st of January 2017, right? On this date, they have acquired an asset at the cost of 500,000 and commenced depreciation immediately on a straight line basis, right? So this is the depreciation method they have adopted. The asset was estimated to have no residual value. Residual value is nil, and a useful life of 25 years. After 2 years, it means, right, on 31st December 2018, after 2 years, it became apparent that the pattern of consumption of benefits was such that the reduce in balance method of depreciation would be more appropriate using a rate of 25%, right? So on this date, they have, right, so annually they reassess whether our depreciation method is appropriate or not. On after 2 years, they have determined, right, reduce in balance method will, right, reflect a better picture, right, on the pattern of consumption, right? So the depreciation method has been changed after 2 years. So we are required to calculate the depreciation charge in each of the years ended 31st December 2017, 18 and 19, right? 2017, from 1st of January to 31st December, right? Cost of the asset is 500,000, right? Residual value is nil, therefore depreciable amounts equals to the cost of the asset, and our useful life 25 years. It means 500 over 25. So this should be the depreciation charge for the year ended 31st December 2017. Right. 2018, right? 2018, the things has not been changed, right? So we had the cost of this much, 500,000. From that we have already depreciated 20,000, right? Residual value is nil, right? For another 24 years we can use this asset, right? For another 24 years, it means, right, again our depreciation charge should be 20,000, right? 20,000. 2019, right? So for the year 2019, right, we have to change our depreciation method into reduce in balance method, right? Right? No more we are going to use the straight line method. If we have used the straight line method, this is what happens. On each year, we are going to depreciate the same amount, right? So from 2019 onward, we have changed to reduce in balance method, right? So the rate is 25,000, right? So the initial cost was 500,000. For 2 years, we have depreciated. Therefore, accumulated depreciation is 40,000, right? The sum of these two, it means the carrying amount is 460,000, right? This need to be multiplied by the rate 20%, right? 460,000 into 25%, right? For 2019, right, we need to depreciate, right? We need to depreciate, or the depreciation charge would be 115,000, right? 115,000, right? Then, right, we will move to our next key topic, that is, right, on revaluation, right? Revaluation. So revaluation can be an upward revaluation or a downward revaluation, right? Upward revaluation, right? An upward revaluation is recognized as other comprehensive income and accumulated in equity in a revaluation surplus, or we call revaluation reserve, right? So what do you mean by an upward revaluation, right? We discussed earlier, when it comes to subsequent measurement, the entity has the option either to use cost model or revaluation model. If the entity chooses revaluation model, right, then it will be resulted in either an upward revaluation or a downward revaluation, right? An upward revaluation means, for an example, if the cost of the asset is 1000, right, and in the following year we revalue it and the revalued amount is 1500. Cost of the asset was 1000. When the very next year, when we revalue it, right, we found that the value of the asset should be 1500, the revalued amount. Then the original value has gone up, right? So that we identified as an upward revaluation, right? So the double entry goes as asset account debit, revaluation reserve account credit, right? Asset account debit, revaluation reserve account credit, right? So but here there is an exception, right? The exception to this rule is where the asset has previously been revalued downwards, right? If the asset has been previously revalued downwards, right, then there is an exemption. In this case, the upward revaluation first reverses any downwards revaluation previously charged to profit or loss, right? Any excess is recognized as other comprehensive income and accumulated to revaluation surplus, right? Revaluation reserve account, right? It means, right, we have acquired a particular asset at a cost of 1000. Assume like that, right? We have acquired at a cost of 1000, right? So after the end of the first year, right, we have chosen the revaluation model and we have revalued that asset and we identified the revalued amount as 800. So it means it is a downward revaluation. Initially it was 1000. After 1 year we revalued and identified the value to be 800, right? Original value goes down, downward revaluation. Then when it comes to the end of the second year, right, end of the second year, again we revalue, and then there we identified the new value of this asset, right, new revalued amount of this asset to be 1500. From 800 to 1500, right, an upward revaluation, right? What is the double entry we are using for an upward? Asset account debit, revaluation reserve account credit. But this whole increase of 700, right, whole increase of 700 we cannot, right, credit to the revaluation reserve account. Why? Previously we have identified a downward revaluation, right? So when it comes to a downward revaluation, downward revaluations are reflected in our profit or loss, right? Downward revaluations are reflected in our profit or loss. So first we need to compensate for that 200, right? We need to compensate. We have in year 1 we have deducted 200 from our P&L as we have expensed, right? That we need to compensate, right, when we have an upward revaluation. That is the first thing we need to do, right? From that 700, 200 we need to credit to the P&L, and the rest of the 500 only we can credit to our revaluation reserve account, right? That is what it says here, right? So we will discuss this with an example as well, right? Subsequent depreciation, right? A revalued asset is depreciated in the same way as an asset held under the cost model, right? With depreciation spreading, the revalued amount over the assets remain in useful life. You know, the management can choose either cost model or revaluation model. If the revaluation model is picked, right, we have a new revalued amount at the beginning of each year, right? So we need to consider that amount as our depreciable amount, right? That is what it says here. So revalued amount is the one we need to divide by the useful life in order to determine the depreciation amount. Right. Downward revaluation, right? Initially it cost 1000. End of the first year we estimate no, it is no more 1000. It should be 800. The revalued amount. Downward. The value has gone down. Right. A downward revaluation is treated in the same way as an impairment and recognized in profit or loss. Right. If it is an upward revaluation, we debit the asset account and credit it to revaluation reserve account. If it is a downward revaluation, we have to debit the amount to the P&L and credit it to our asset account. Right? There is also an exception. Right? Exception to this rule is where the asset has previously been revalued upwards. Right? The opposite of my previous example. Right? 1000 is the cost. After the end of the year 1, we have revalued to 1200, upward revaluation. In the end of the second year, we have revalued again and found the value to be, right, assume 700, right, from 1200 to 700. That 500, right, we cannot charge as it is to the P&L. First, we need to compensate for the upward revaluation, right? So it is in the revaluation reserve account, right? The 200 has been credited, so we need to first remove that, and rest of the 300 only, right, we can debit it to P&L. Right. So we have an example. Example number 5. Example number 5. Right, on revaluation. Right. Example number 5. Right. A downward revaluation is treated in this, right, sorry. A company acquired land on 1st of January 2011. Right, on this date, company acquired a land. Right, land, do we depreciate? No. Why? Right, we are not known the useful life. Right, useful life we cannot determine, therefore we are not going to depreciate it. In order to find depreciation, we know, right, we should know the depreciable amount as well as we should know the useful life. Right, if we don't know the useful life, means we cannot determine the depreciation, therefore land we do not depreciate. Right, at a cost of 65 million, right, the land was subsequently revalued upward to 68 million. Right, 68 million on 31st December 2014. On this date, this has been revalued to 68 million. Right. And, right, at the end of 2017, as a result of a fall in market values, the fair value of the land fell to 63 million. On this date, again they have revalued, now found the fair value to be this much. It is 63 million, has gone down. The market recovered in 2019, and by the end of that year, the land had a fair value of rupees 70 million. Right? This is the fair value as at 31st December 2019. Right? We need to require, so right, we require to record each of these revaluation. Right? This one, initially the cost was 65 million. And we have revalued on this date, found the fair value to be this much, 68 million. Right? 68 million. Right. So it means there is an increase of 3 million, isn't it? Right? There is an increase of 3 million. Right? The asset has gone up by 3 million. Right. So 68 million was gone down to 63 million on the revaluation done on this particular date. Right, from 68 million to 63 million, it means the value has gone down by 5 million. right? So that is a decrease. And again we have revalued on this particular date and found the value to be this much. It means from 63 million to 70 million, the value has gone up by 7 million. Right. So we need to pass the double entries here. This 3 million, it is an upward revaluation. Therefore, land account we need to debit 3 million, and we are to credit revaluation, right? Reserve account credit, right? 3 million. Revaluation reserve account credit 3 million, right? Revaluation reserve account credit 3 million. This is the double entry we need to pass, right? Then for this amount, what is the double entry we need to pass? How can we record this transaction or this decrease of revaluation, this downward revaluation, right? Before that, what we need to see? We need to see what previously has happened, right? Here we have a downward revaluation, but previously we have identified an upward revaluation, right? We have an 3 million balance in our revaluation reserve account, right? First we need to reverse this, right? Or we need to eliminate this. It means, right, revaluation reserve account, we need to debit 3 million, right? We need to debit 3 million, right? Out of this whole 5 million we cannot debit to PNL. Why? We have previously identified an upward revaluation of 3 million, and that has been accumulated to our revaluation reserve account. Therefore, the first thing we need to do is we need to reverse this one. That is why we debit, right? And the rest of the 2 million, the amount exceeds that, right? We can debit to, right? We can debit to PNL, right? Not whole 5 million, only 2 million we can debit to PNL, right? Of course, the value of the asset or the value of the land has gone down, right? Therefore, land account should be credited by 5 million, right? Land account should be credited by 5 million. So this is the double entry we need to pass, right? On the third time of revaluation, right, again there is an increase compared to this value. There is an increase of 7 million, right? So how can we account for this, right? This whole 7 million we cannot credit to revaluation reserve. Why? Previously there is a downward revaluation, right? We have identified this much of amount, right? We have debited, right? We have expensed this much of amount to our PNL, 2 million. First we need to reverse that, right? First we need to reverse that, right? It means, right, PNL we need to credit, right, 2 million. PNL we need to credit 2 million, right? And the rest of the 5 million, right, the rest of the 5 million revaluation reserve account, the rest of the 5 million we can credit to, right, revaluation reserve account. The rest of the 5 million we can credit to revaluation reserve account. Of course, the value of the asset has gone up from 63 to 70. Therefore, the land account should be debited by 7 million, right? So these are the entries we need to pass in terms of these revaluation, right, increases or decreases, or upward or downward revaluations, right? That is example number 5, right? That is example number 5, right? Right, that is example number 5, right? disposal, right? Our next topic, disposal. On the disposal of an item of PPE, right? On the disposal of an item of PPE, a gain or loss is recognized in profit or loss. If it is a gain, we identified it under other income, or if it is a loss, right, we identify it as an expense, right, under other expenses. The profit or loss on the disposal of a non-current asset is the difference between the carrying amount of the asset at the time of its sale and its net sale price, which is the price minus any cost of making the sale, right? So simply, right, the profit or loss on disposal can be calculated by, right, net sales proceeds. Net sales proceeds means the amount we obtain from the sale minus if we have to bear some cost to make that sale, right? Net sales proceed minus, right, the carrying amount as at the disposal date, right? As at the disposal date, what is the carrying amount of the asset, right? The difference we can identify it either profit or loss, right? If sales proceeds exceeds the carrying amount, then that we identify as a profit. If it is less than, right, if our sales proceeds is less than the carrying amount, then we have to identify it as an expense or a loss, right? Example number 6, right? Example number 6, it is on disposal, right here, right? Example number 6, right? What it says: an item of equipment was purchased on 1st of July 2015 at a cost of this much, 100,000, and depreciation commenced immediately, right? Depreciation commenced immediately. You know, the purchase date and the date of commencing depreciation can be different in certain cases, right? Based on a 10-year useful life, therefore useful life should be 10 years and no residual value, right? No residual value should be nil, right? As a result of a change in business strategy, the equipment was surplus to requirement as at 31st December 2019, right? It means on this date we are going to dispose it because it is surplus for our requirements. We no more need that asset, and was sold for 54,000. This is the amount we obtain, right, from the transaction, right? This is our sales proceeds, right? 54,000. Required: explain what profit or loss on disposal is recognized on the sale, right? On this disposal, what is the profit or the loss amount we need to recognize, right? These are the two figures we need to, right, we need to know in order to determine whether we have a profit or a loss from disposal. The sales proceed amount is 54,000, and we have not bared any cost to make this sales happen or make this disposal happen, right? Therefore no any deductions for this, right? Otherwise we need to consider the net sales proceed, right, or after deducting such expenses, right here. So the sales proceed amount is 54,000, right? This should be actually not sales proceed, it should be net sales proceeds, right? The carrying amount, right? We have purchased this asset on this date for 100,000, right? The useful life is 10 years. After how many years we have sold this, right? After how many years? After how many years, right? From 2015, 1st of July 2015 to 31st December 2019, right? 2016, 17, 18, 19, so 4.5 years, right? After 4.5 years, we have disposed this particular equipment, right? So the carrying amount should be cost minus accumulated depreciation, right? Accumulated depreciation 100,000, right, over 10 years into 4.5. So this should be our carrying amount, 55,000, right? 55,000. So what is there, a profit or a loss from this disposal transaction, whether it has generated as a profit or a loss, right? Our net sales proceed is 54,000, but our carrying amount is 55,000, right? So the carrying amount is higher than the net sales proceed. It means that is a loss to us, right? From the disposal transaction, we have generated the loss of 1,000, right? It is a loss, right? It is a loss, right? Right. Right, and finally on disclosures, right? So if you have gone through an annual report, right, we have a PPE note, right? Several disclosures to be made with respect to property, plant and equipment. Why? This represents the highest balance in the balance sheet in most of the cases, right? In most of the industries, right? So when it comes to disclosures, right, these things need to be disclosed, right? Must be disclosed, right? Right, for an example, measurement basis for determining the gross carrying amount, right? What measurement basis we have used, right? What is the depreciation methods we have used, right? What are the useful lives and depreciation rates we have used, right? The gross carrying amount and accumulated depreciation amount we need to disclose, and we have to do this one, reconciliation of the carrying amount at the beginning and end of the period, right? That is in the PP note you find this, right? So apart from this, right, if we have used the revalued or in for subsequent measurement, if the company, if the management has used the revaluation model, right, with respect to those revalued asset, right, so these additional informations need to be disclosed, right? For example, the basis used to revalue the assets, on what basis you have revalued these assets, effective date of the revaluation, right? Whether an independent valuer was involved, right? And the carrying amount of each class of property, plant and equipment that would have been included in the financial statements had the assets been carried at costless accumulated depreciation and accumulated impairment losses. If these assets has not been revalued, right, or if these assets has been, right, measured on cost model, right, what is the carrying amount should be, right, as at this particular date, as at the end of the financial year, right? And revaluation surplus, indicating the movement for the period and any restrictions on the distribution of the balance to shareholders, right? This additional information we need to disclose only with respect to revalued assets, right? So in nutshell, so LKAS 16 property, plant and equipment provides the guidance on recognizing and measuring non-current assets, right? So these usually form the largest balance in the statement of financial position, especially in the case of manufacturing companies, right? And when determining whether a particular asset can be identified under property, plant and equipment, the definition plays an important role, right? Based on the definition only, right, we can decide whether this asset can be regarded as a PPE or not. The second point says the recognition criteria of LKS 16 are the same as those in the conceptual framework. You know, we have discussed that there are two criteria to be met in order to recognize an item of PPE in our financial statements, right? An item of PPE is initially measured at cost, right? By seeing this term cost, you know what this cost is comprised with: purchase price, right? And directly attributable costs plus cost of dismantling. LK 16 allows a choice of measuring assets using either of the cost model or the revaluation model on subsequent measurement, right? So whatever the model we choose, we need to be consistent with that. Depreciation must be charged on all assets except land, right? We have discussed the reason why we do not know the useful life, right? The useful life can't be determined exactly, right? It is unknown, right? Or it is indefinite, right? The useful life of land are regarded as indefinite, right? Therefore we cannot, right, determine the depreciation charge with respect to lands. The depreciation amount of an asset is allocated on a systematic basis over its useful life, right? Systematic, right? Depreciable amount over useful life, right? An upward revaluation is recognized as OCI, or other comprehensive income, accumulating into equity, right, as revaluation surplus, and a downward revaluation is recognized as, right, a downward revaluation is recognized as P as in our PNL, as an expense in our PNL, right? On the disposal of an item of PPE, a gain or loss is recognized in profit or loss, right? On the disposal of an item of PPE, it can be generated as a gain or it can be a loss. Whatever it is, we need to recognize it in our profit or loss. And LKAS 16 requires a number of disclosures, including a reconciliation of carrying amount at the start of the year to the end of the year, right? There are number of disclosures we need to have in terms of LKS 60, right? So these are the things we have discussed in terms of LKS 16, right? So with that, I'm going to wind up this session, right?